Welcome back. There is some pressure on the market, like we've been telling you, practically at the lows of the day. Satish Ramanathan, CIO of Equities at JM Financial Asset Management is joining in. Satish, pleasure having you on the show today. So before we start talking about your approach, your portfolios and, what you're picking and choosing, just a sense on the fact that we are so close to all-time highs, but something or the other seems to be souring sentiment. And now it seems to be all this global talk, this US debt ceiling. What's the sense you're getting on the market? We've had a sluggish first half, barely managed to come back to all-time highs. Second half, what are you predicting for the market? I think you're on mute, Satish.
Good morning, and thanks for having me. I think what we expect is that the market momentum in terms of earnings is going to pick up from here on. We've seen all the raw material prices coming down. We have seen the WPI, CPI gap expanding, typically meaning that WPI indicator of raw material prices coming down. So margins should be looking up for corporate India from here on. And we saw this improving in the March quarter. We'll see this expanding in the June quarter and probably reaching its peak by the September quarter. As regards market sentiments, what we see is that, yes, there are a lot of global crisscross currents taking place. Difficult to predict, but I think we should just focus on earnings and earnings growth domestically and keep investing there.
So, okay, just to follow up on that, you said earnings should get better from here on. What is the actual increase you're penciling in for FY24? And we're trading, I think, around 19 times as of now. So do you expect multiples to head higher from here?
Multiples ought to stabilize here. It may not move up given the money flow issues that we have globally. But at least we should pause here from the valuation side. We shouldn't drift down too much from here on. One. As regards the earnings growth, what we have seen year to date, the last quarter, we have seen 400 companies report. We've seen a 10% YY growth. And I think this will keep accelerating as the commodity prices cool off. Banks, which were a significant contributor last year due to NPLs coming down and provisioning coming down, would probably start cooling off unless they have credit growth. So banks would be a lower contributor to earnings momentum as compared to the manufacturing space.
Satish, morning. This is Reema Tendulkar here. I remember in our last conversation, you said that you see value in emerging infrastructure assets, and you were quite bullish on names like KEC, Kalpataru Power, and even large cap companies like L&T. Now, when it comes to manufacturing, another space, the electronic manufacturing space has turned very hot. And this quarter, all the companies have reported good numbers. Dixon, Amber, Keynes. Are you looking at electronics manufacturing as a space? And is there value? Or do you think stocks have run up too much?
The stocks have run up, but structurally we like these businesses because I think we are in a good place there. We need to localize. The government is creating incentives to localize this business and increase domestic consumption, exports also. So I think that's a good place to be in. And we do hold some of the stocks that you mentioned.
If the valuations right now are expensive, can someone buy at current levels?
While we don't give recommendations, what we do say is that if you take the longer term view, I think there's value in these stocks, in many of these stocks.
Okay, Satish, another pocket which has really stood out this earnings season has been the auto pack, right? I mean, across the board, we saw a lot of good surprises come through on autos. Do you think that this is a place where you're willing to take a bet? And if you do want to play the auto pack, which way would you do it? Do you look at the two-wheelers? Do you look at, the regular car makers? Is it the ancillary companies? Anything from that basket seem attractive at current levels?
I think the auto sector would also be a beneficiary of lower input costs. And we have seen this play out to some extent. And there is still some juice left in these names because primarily what we see is that the input costs could keep heading down for many of these leading manufacturing companies. And also the interest cost could come down for the consumers. The only wild card as it stands is the fuel cost and the technology issues that we have seen play out in terms of EVs and things of that sort. But broadly speaking, I think the auto pack should continue to report decent numbers going ahead.
Okay. What's the expectation from the consumer space, the way you see it, Satish? If you could just sort of cut it up between staples, where trends have been extremely mixed, and also discretionary.
So in terms of staples, I think we have seen some of the input cost pressures easing, and we have seen margins actually expanding for some of them. I think they hit a low about 3 quarters back, and since then sequentially margins have improved. But what's happened is that consumption itself has taken a bit of a backseat, especially rural India. So that's something which needs to stabilize. So once the volume pickup and volume growth starts kicking in, and the margins are at a at a higher level due to lower input costs, then we should see these earnings momentum picking up. As regards consumer durables, what we see is that they have been impacted a lot by metal costs going up, and also in terms of financial leverage being a little tight. I think both of this is kind of unwinding itself and should aid earnings momentum for these group of companies.
All right, Satish, got that. And we will leave it at that today, but we hope to have you back with us very soon to discuss more on the markets and some of these individual pockets as well. We were talking so much about, the raw material prices and the commodity costs. So we're going to take a short break.